To my left, first up is Dan Connolly. Dan is an active angel investor and funds emerging growth companies alongside angels and life InfoSci investors. As leader of New York Angels since '98, he coaches, advises, and guides entrepreneur CEOs. He also coordinates Entrepreneurs University programs through Univy? All right, good, got it. .org, a 30-year-old young non-for-profit educational institute for entrepreneurial CEOs who learn best practices to raise capital to become more fundables. Dan's group is actually on a Northeast basis and integrates with many entrepreneurs. Next to him is Rich Foster from Foster Management and Holdings. A lot of us know Rich out here in Long Island. He's a serial entrepreneur, angel investor, and professional speaker with a passion for new business development. He's the managing director of Angel Fire Ventures, an angel investment fund focused on deal syndication of some of New York City's best angel deals. Rich serves on the board and is actively involved in an executive capacity in several of his portfolio companies. Next to Rich is Charles Parmalee, or he likes to be called Chip. Chip is a principal of Parmalee, McDermott, and Thomas, which is an insurance agency, but there's a bigger story behind that. Chip is a limited partner in 6 venture capital funds today. Chip has been doing this for probably over 20 years and has been active in many PE funds as an investor. He's a strategic insurance advisor. He's a mentor to the Entrepreneurs Roundtable Accelerator, an early stage seed fund and technology accelerator. He's a charter member of the Indies Entrepreneurs, a global network of entrepreneurs and professionals established to foster entrepreneurship. So I'm going to, now that I said that whole bunch of stuff, actually, would each of you just add a little color to what I'm saying for why you're here and what you can lend to everybody and what you're looking for? Okay, so Chip, you want to go ahead?
So we'll go by age. Okay. Yeah, my name is Chip Parmalee. By the way, thanks very much, Corey, for having me. I'm here with my brother Jim out there. I was saying earlier that if you come from Princeton, New Jersey to Long Island, if you can get through the Verrazzano Bridge before 6 a.m., you're going to make it. So, which we did. So I guess I had a little bit of luck. My dad had an agency in New York, which he founded in 1953. I joined him in '77 and had the fortune of meeting a couple of VC funds in the Princeton area, one of which became a top-tier fund, Accel, as in Facebook Accel, and they became clients. I started doing just nominal insurance stuff for the funds themselves, and I saw it was a business model that was unfolding in front of my eyes, because if I could do a good job for the funds themselves, then I could work with their portfolio companies. And it was very fortuitous because it was at the time that the venture capital market was starting to take off. They were changing the regulations relating to what were acceptable investments in public pension plans at the time, and making venture a legitimate category, because up to that point it was really what they now call family offices and college endowments and that kind of thing. So I grew the venture capital insurance brokerage portfolio probably by '87, when we had our first market crash, to about maybe 20 to 25 venture capital funds, insurance clients. And then when .com started to take off, we grew it to about where we are today at 50. In the late 90s, we started deploying some of our own capital into partnerships, and have since gone into, as Corey said, 6 of them. We're in the NJTC Venture Fund, which is affiliated with the New Jersey Technology Council. We're in a growth equity fund called Silos Group, which does much larger bets where all the technology risk is mitigated, and it's really just market execution risk. In medtech, healthcare IT, and healthcare services. We're in 2 seed funds, one in New York called High Peaks Venture Partners, which makes small bets and then doubles down on the winners in the e-commerce and SaaS space. Just had a big win in Jet recently. Of course, we only had $250,000 invested in Jet, but that's another story, which I'll tell you about later. They reconfigured their partnership and put a new sort of brand name on it, which is now called Primary Venture Partners. We're also in a clean tech fund called Caithness Energy Partners, which does oil, gas, minerals, that kind of thing. Then we went into a Philadelphia partnership called Osage Venture Partners, which is in a third security, a third healthcare IT, and a third probably digital media. A-round investor primarily. It's about a $110 million fund. And then we've doubled down in a couple of these partnerships. So it's really 6 in total. Direct investments, we've probably done 15 to 20 direct investments. Pretty much agnostic in that area, which I'll get into more detail, but we're in everything from ed tech to medical tech to fintech. We've done a couple of e-commerce deals. We did a drug discovery deal. And so that's all for now.
Rich?
Sure, so a little bit more about my background first. I had started my first business about 14 years ago. It was low-tech industries, I like to say. I designed and manufactured clocks that looked like baseballs, footballs, soccer balls, etc. Started in my parents' garage. Ended up with 7 US patents for the products and international distribution in 15 countries. As I was scaling that business up, I ended up wanting to control the manufacturing processes. So I went and I bought a vertically integrated business, which was a cabinet making company in 2008. Obviously, as everybody knows, the real estate market wasn't good in 2008, so it presented a number of other opportunities for me as well. And between 2008 and 2011, I rolled up commercial construction companies. And clients included Macy's, Bloomingdale's, Allure, Sunglass Hut, Coca-Cola, Polo Ralph Lauren, all major retailers. And I started exiting those companies in 2011, and that's when I started getting involved in angel investing. 2013 came and I co-founded Launchpad on Long Island, which presented an exit opportunity for myself last year. And in the interim, I co-founded Angel Fire Ventures with my partner, Harvey Brockman. And we started coming up on about 2 years ago now. We've done 7 deals. We focus on early stage, either Series Seed or Series A deals. And we have a unique model in that we're strictly a syndicate model. We don't take any direct applications on our website. You have to come through another VC fund or angel group that we have a relationship with. And what that does, it gives us a really well-curated pipeline of deals to choose from. So you take a group like New York Angels in the city that gets typically 100 to 130 applications a month. By the time that gets whittled down, 1 or 2 companies get funded. So we get to look at those 1 or 2. Now pull that across the other 10 groups that we syndicate deals with. We have really a very well-curated pipeline that typically starts with over 1,000 deals a month, but ends up with the 10 or 15 that we get to look at. And Angel Fire, of our 7 initial companies, 2 have successfully exited so far in the span of less than 2 years. And we're in the process now of starting the fundraising process for our new fund.
That was great. Thank you, Rich. Dan?
That was great. Nice work. And Chip, too, that long story from the ground up. This is a wonderful thing. So I do 3 things. And the passion thing is the nonprofit educational institution called Entrepreneurs University that Corey mentioned. So this is essentially the MIT Enterprise Forum's original model, which is what we started calling ourselves back in '84 when we got founded, but there was a struggle over the control and the name, so it's the Entrepreneurs Forum, Inc. And as Entrepreneurs University. So this is a deconstruction and reconstruction process that is healthy for all entrepreneurs and business professionals alike. I just want to compliment the presenters here, these last bunch of entrepreneurs. They got it, man. They look fundable. You're going to find your investors. It's going to be wonderful stuff. Really high quality companies presented here. I just want to compliment the organizers and blame Jeff Bass and Neil Kaufman and Corey and Carol Lane. Thank you, Carol. So with all that said, we're doing this same entrepreneurial university month after month after month. So I've been doing it for 26 years. And so connected with all these different angel groups on the East Coast. Trying to recruit, brain trusts like the Parmalee brothers to come and help out and, pick up an oar and pull and give coaching and such, because it's wonderful to find folks that go out there and do that. They're giving to get, unlike the entrepreneurs who are trying to get to maybe give. So we're very nurturing, we don't do anything rubber bullets wise. We have entrepreneurs and residents that come back year after year. So a lot of those companies, so we summarize in this flyer here that you can get from me via email. This lists a whole bunch of our typical annual program style about best practices, avoiding the rocks, you know, making sure you're more of a bulletproof presentation before you go out there and kill yourself with those, you know, few really important investors who could, would, or should take a serious look or referral. And then you can see the programs and then some follow-on investments. The one recently from Long Island Capital in January, PavMed went public, and just complimenting Leica for keeping this drum roll going. And then over here on New Jersey Angels, the for-profit side, these are the small 5 to 6-figure investments that me, my family office, and these other folks on my Rolodex say, okay, Conley, show me what you're invested in. Maybe I want to get involved. So in the past 10 years, there was just one a year. It was an excruciatingly sort of anal retentive due diligence process. You know, what do we don't know? What do we don't know? And we're worried all the time. And so these things have worked out really well. And so this year in 2016, we've already made 10 new investments, and we're looking for a couple more. We've gotten all our money back for our investors, and then some. And we have a particular mission on preventing blindness, genomics diagnostics. We're working with a company that's going to repurpose the Maine woods. Who knew? And so we find some fabulous, our big company that we got the big return with used a special technology for angels called an angel dividend pool. When you work with a company that's definitely going to get a license from Big Pharma, you can force the company to cough up a third of that licensing revenue. In this case, it was $350 million ka-ching from Astellas Pharma to Immunomics, because they bought the entire discovery platform for this LAMP anti-allergy vaccine, tree nuts and peanuts vaccine allergy. So, and that was fantastically structured. It's a new technology. So we outcompeted all the other companies that were raising angel money at that time. They said, oh wow, because normally when an institution comes in, the angels will never get their money out until the company is sold, as was pointed out by Daniel Wolf. We find that if we can get this angel dividend pool technology into that angel raise, in this case it was 112 angels for 12-something $million, we'd be able to jump right through and wrap up and roll phase 2. So the big pharma said, aha, I'll take it off your hands now. And that's going to be a more common practice with some of the syndication you heard, referrals, and the like. So the angels are coming back with a vengeance, but they're nice still, and they're looking to organize and find domain expertise everywhere before they put up their family's money, because we all like a nice Thanksgiving dinner.
Well done. All right, so having said that, with your stellar intros, what is your feedback for the presenters? You know, what was done well, what if anything can be done better, or needs to be addressed? And just randomly go through it. So, Rich, why don't you go?
Sure. So in no particular order, I guess. I'll start with the connect and sell. It seems to me like, I guess, just lead gen in a sense. And I wasn't sure how different it was from stuff that's already out there. The fact that there seemed to be a fallout on clients. I don't know where he is, so I can speak to him if he's here. But all right. So the fact that there was some fallout on clients from that initial 1,200 or the total 1,200 makes you wonder, because everybody always wants more sales, in my opinion. So the fact that people aren't sticking with the product was an interesting takeaway, I guess. So if I were him, I'd look to figure out how I can get that number up and keep the retention higher.
Okay, good.
I always like to present the story of the team in the first slide. What I've found with most institutional investors, and it seems like everybody was pretty much looking for either a note, but ultimately institutional money, that they're looking for a vision. They're looking for a large market, a market that's growing quickly, preferably somebody who has some barriers, either in the form of a patent, but they're also looking for a story about the team. So I always like to suggest putting the team on the first page of the PowerPoint presentation. And if you got a unique story, such as, you know, you worked in a big pharma company together and you came up with this idea, or you worked in an e-commerce company and came up with an idea, showing that you can work together and you have history with the individual people who have set the team up. I think that that's very important, because what I found with most of my VC friends, the last thing that they want to do is fund a team that maybe is not transparent, but more importantly, where they may have to can somebody midstream, because that's obviously very disruptive. I mean, obviously, if the team really starts to, the company really starts to scale, they may have to bring in some professional management, and that's a discussion that is always had up front. So that's the only suggestion that I made. I thought the structure of every single presentation was dynamite. I thought all the bullet points were in there. I thought that there was not a lot of wasted words, but it's really focusing more on the team. Thanks.
Just to follow up on what, not to jump in front of Dan, but team is, I absolutely agree, the most important thing that we typically look for. I mean, this is a business where you're betting on the jockey, not the horse. And bringing the right team to the table, we absolutely agree, is by far the most important thing.
Well, is this loud enough? Everyone got me?
Yes.
So I thought my new investment today is behind Harrison Harris. That was a pretty fundable presentation with a couple of videos, and so I'm going there. Mostly because I'm not in the .com e-commerce things, and you're able to leverage a lot of different things. So thank you for what you're doing. It's an inspiration to, and you're showing other people how to get into those preemptive piggybacks and things of this nature. So it really, everyone's always looking for an edge. I think that we had some excellent presentations. They're fundable. I just came from a week-long of series of presentations. I no kidding, literally interviewed with over 85 CEOs just this week. And we do have 4 or 5 of them in due diligence already. We're trying to move as fast as possible. I highly recommend that all entrepreneurs, we teach this at our nonprofit, and we say it out loud and proud, and it has to do with having a good law firm. And I'm not going to pick on Neil Kaufman, he knows his good law firm. But what we want entrepreneurs to be doing is to at least think through everything to, like, it's a private place, a memorandum level thought process, and being able to identify the risks that are obvious to investors sometimes aren't even obvious to the entrepreneurs. They're in denial, they don't have to talk about that so much, or they can cover up some of the troubles of the past. But a PPM level set of disclosure risks, and I guess we're going to pick on Mark Alenowitz at TriPoint Capital for the new technologies that he and his group can bring to the marketplace, which are this best practices and using the Jobs Act so perfectly. And I think entrepreneurs ought to be migrating toward that if they're not already there.
Wait, you jump in. You jump in, we're gonna go there.
No, just
So, what happened to the accounting firm? We're irrelevant? I mean, what's going on here?
okay. So Corey, I can tell you, but most entrepreneurs only need QuickBooks Online. But if they're going to get
Initially,
serious,
yeah, I agree.
serious outside investment, it's time to get a hold of like an accounting firm. They're just so they tend to live in the treetops. They're not down here in the primordial super so much, because it is a QuickBooks Online place.
Okay, so let's discuss a novel thought. What would your criteria be if you were to select an investor? So, Dan, go ahead. You were going down that path for a second.
If I'm an
If you're
entrepreneur,
a company, everybody wants that money, but they never really get selective about who they're gonna pick as their investor, because then sometimes they'll get into somebody that could be toxic, they can get into somebody that's not strategic, that's hands-off, that they're looking for.
We
I can
have
keep
a
going,
toxic
I'm queuing you up on this,
okay,
so.
so we have a toxic situation in one of our companies, so maybe I should be doing some push-ups. But when 2 board members have a severe disagreement over a strategy, it needs to be done in person and with witnesses. So, your point, so here's how I would go about it, right? In other words, a good entrepreneur who wants to cover his assets and prove to his family he's not an idiot and the like, that he should be starting out with the regional noted law firms, sponsors of organizations like this, and go to them and say, who are the 4 or 5 or 10 maybe investors that would be suitable for me? And he goes also to the accounting firm. He says, I'm really planning to do this venture. Who would you put on the list? And so then there's sure, you gotta have directors and officers insurance sometimes. So you wanna go and get the samplings from the sponsors, the lubricity, the people who make stuff like this happen, and they make all the transactions close. And get their list, and then just cross-reference, see if you gotta offer investors a steak dinner, or lobster, or something really nice if you're expecting them just to come out for free and give advice. So bribe your investor prospects as much as you can.
And Rich is smiling while you say that. And Rich.
So as far as what to look for an investor, I always say there's a lot of money out there. It's a matter of finding the smart money. I think you want to have multiple investors in a round. I mean, companies that only go and find one large institution. You know, if you're raising, especially in the earlier stages, if you get, you know, a JP Morgan or Andreessen Horowitz that goes and says, all right, well, we'll fund your $300,000 seed round, they're not going to give you any time. You're better off partnering with smaller VCs to start off with that are going to introduce you to their connections. They're going to help build up your network, that are going to bring you the clients that you need. And I mean, that's one of the things that Angel Fire, I think, we do really well. We communicate with all of our LPs, and our LPs bring a lot of value to the table for the entrepreneurs that we work with. And I think that's really one of the keys when you're looking for an early stage investor, not just about the money.
Chip?
Well, my friend Brian Cohen of New York Angels always refers to me as the great storyteller, because I've been doing this for a while and I have a lot of stories, some good ones and some bad ones. But I would say that you really have to do your own due diligence on not only the fund, but also the person at the fund that you're talking to. So the first story I'll give you is regarding a top-tier fund, one of my oldest fund relationships, based out in the West Coast. And the founding general partner has been a great friend to me over the years. He's introduced me to all of his junior partners and the portfolio companies. I've sent him deals to look at. Anyway, he was retired as of 12/31, and so in light of that, he introduced me to all the young guys, and they were all great, except for this one guy, who was an e-commerce guy. And he had a number of very high-profile exits, you know, Dropbox, a few others. He was in on Quidsi. And, you know, the guy canceled probably 10 conference calls with me. It was a sort of meet and greet conference calls. None of the other partners did that. And something struck me the wrong way about this guy. So I said, you know, I want to do some of my own digging. And it just so happened that he was the lead on 3 of our e-commerce insurance clients in New York. And I felt comfortable asking the CEOs of each of these companies what it was like having him on the board. And I got the same comment in each case. Always wants the board meetings to be in Palo Alto, number 1, which was an inconvenience for the portfolio companies. Number 2, is never prepared for board meetings, always click at board meetings, and is always late. And you know, my point to the CEOs of these 3 companies is you've got a time clock that's running. And shame on him. Not only is he taking up a valuable board seat, which he's entitled to because he's the lead investor, but also he's representing his fund, which is a whole slew of other general partners in that fund. That's story number 1. Story number 2 really involves our good friend MPD. And MPD, who was a venture partner of another fund that we're actually investors in, when I first met him, I said, you know, Mark, you've got 8 VCs in your deal. This is an early stage company. And I said, is that a little bit cumbersome? And his comment to me, and he sort of looked at me quizzically, he said, well, it wouldn't be so cumbersome if half of them, whose names I won't mention, would be more responsive, i.e. returning emails, returning phone calls when I need help. Because especially at the early stage, the job of a VC is to be the consigliere to the founder when you need help on fundraising, on strategy, on customer introductions, on finding people. I mean, that is really their job, because money is cheap. And the third story I'll give you is regarding a good friend of ours by the name of Yogesh Gupta. Some of you may know of him. But Yogesh has become a terrific friend of Jim's and mine, and he had rescued a company out here, out in Minneola, called Fatwire, which probably many of you remember was sold to Oracle. And Yogesh was the guy that recruited from CA, turned it around, made Barry Rubenstein a lot of money, Wheatley was going to lose their shirt in the deal, and I think they were the lead at the time. Anyway, Yogesh ended up moving to Boston and teamed up with a fund that we didn't introduce him to, but very reputable fund, a fundraising machine. I think they've been around since 2000. They've already closed 8 venture funds. So obviously they had very good returns. He had a guy who he got along with very, very well. They bought a cloud-based software company that had been around for about 25 years. Management was looking to get out and move to some island, cash in their chips. So they recapitalized the company, installed Yogesh as the CEO, and Yogesh at CA was a growth guy, do M&A. That was his forte. And so that was the strategy with this growth equity fund. A year into the game, they brought him in and they said, you know what, Yogesh, what we're going to do is we're going to start managing this company for profitability. So basically they pulled a bait and switch on him. And they didn't want to give him any more money because the company was plenty profitable. And my brother and I were having breakfast with him one day up in Boston. He's telling us the story, and he said to us, why do you think they did this midstream? I mean, things were really going well. And I thought about it for a minute, and I said, number one, they were probably getting ready to raise a new fund in the next year or two. They probably had a couple of dogs in the portfolio where they wanted to reallocate capital to the dogs so that they didn't have any write-offs that they had to show the LPs. And so I said to him, I said, you're the chairman of the board, but I saw they moved you aside, as president CEO. He said, what do you guys feel about that? Should I stay on with this company? I said, would you do another deal with this fund? He said, no. I said, you answered your own question. So very prestigious fund, fundraising machine. Obviously the returns were there, but you have to be very careful who you get into bed with. Because, you never know unless you do your own due diligence. And he probably never would have known this. It was a hard luck story.
That was a great story. So the point of it is that if you do go, an angel investor, you could do a background on, easily because that's an individual, or, you can do Rich and his partner Harvey. But when you go into a fund environment, there's a lot of nuances baked underneath the skirt on those. To your point, where is the fund? What stage are they at? Are they, in Rich's case, Rich is going out there to raise a second fund.
Correct.
That's information you would need to know. Or the maturity of the fund, to Chip's point in that situation. So those are the things you wouldn't think of. So, it's great to have that person invested and willing to give you money, but that's like a marriage, and there's a future there. You got to do a little more digging. Let me ask you, how about this question? What are some unorthodox methods you would recommend for fundraising? Not the standard deck, with creative ways that you can go out there and kind of look for money. So, I see Rich smiling, so.
I don't know if that means I have an answer or not.
Well, how's about the connections? Go to connections for now.
Yeah, I think that's always what I recommend first. It's similar to what Dan mentioned earlier. I think going through a network of contacts or your network of contacts makes the most sense. I don't know if that's creative or not. I think it's just smart. I've seen people do creative things that I wouldn't recommend. Going on LinkedIn and emailing everybody, I'm doing a private raise right now. That's something I wouldn't recommend.
Or we can go to what you got to be careful of is that someone walks over to you and says, listen, I have connections and I can get you money. Well, there's a nuance there that
Are they licensed?
Are they licensed? And no one realizes that they need to be licensed, and neither do they, by the way. So.
Or they do and they don't want to admit
some
to
of
it,
them
one or the
know,
other.
they know.
Exactly.
Yeah.
Finders galore. I don't think it's going to be an unorthodox method. It's not going to be an unorthodox method for long, but this Reg A Plus is now finally, everything's been decided. And that, compared to the old days of, the empowerment of the press, if you will, that could talk to anybody, not just accredited, that's a big deal. And so now, you know, everybody can sort of get into it if it's only a couple of $1,000s as it would be. And I guess that could either create a lot of money and a lot of lawsuits, or if it's fully clarified, it's a lot of money without a lot of lawsuits, and that'd be wonderful, and just to free up a lot of capital that's sitting in. It's not just a family office that goes to Cavendish or some of these other Opal Group type of events. The families that are, you know, gee, let's not buy the boat, let's put the money to work so we can have a college fund for these teenagers or these kids. Some other practical use, it frees up a lot of money, and there's another, I don't think it's a technology per se, but there's some global angel networks, for example, Keiretsu Forum, and they're very good, and they have a due diligence process, and I don't know if their business model works so well because they're trying to get rich people to do free stuff for entrepreneurs, but you know, there's a lot of that already going on. I would say that the Keiretsu Forum method of the due diligence process is very helpful, and the other couple of tidbits there is that David Rose wrote at least 2 books, you know, Startup, and he has the Startup Checklist. And for those of you, all you entrepreneurs who haven't seen those, there's a whole bunch of checklists. You really are doing a great service for yourself to get it, have your whole team recognize what it is you need to have and how close you are to having it. And that internal checks and balances are very important. You know, before you go out there to raise capital, CYA.
Chip?
Well, you know, how often do you meet the right girl or the right guy, you know, and it's love at first sight? I always say, you know, you raise money when you don't, I mean, you start looking to raise money when you don't need it, and starting off a relationship early, I think, is really the best way to go, so that you get to know the investor and they get to know you, and then they can start tracking you and see how you're making your milestones. Stay in touch with them if you have a new hire or if you have a new customer. You know, be your own PR agency. I would say more on the HR side of things. Venture people like to be scrubbed, and they like to be told that they've got a remarkable network, which they're always very protective of. And so do your due diligence. So if you've identified a GP of a fund, male or female, and they've had some terrific exits that you think would be great customers for your little company, that should be pointed out. If it's obvious that they know Mark Lorry, you know, because they funded Jet or Quidsi, and that is a guy that you'd like to get to know just to learn more about e-commerce, you know, that's something that you should point out to them. Just convey why you want their money versus the other guy's money or the other gal's money, because they like to hear that, and they like to know that their network has some value, because that's really what they're selling.
All right, so at this point, I'm going to open it up to Q&A. So does anybody have any questions for the panel? All right, then I'll keep going with the questions. So last one. So having said that, you know, how deep do you go? We said that you're going to stroke your investors, right? You people you meet. You know, and then yet these companies are trying to focus on their product, build a business at the same time. So if you're thinking about the ROI and the amount of time that it takes to do that, is it really worth it? My answer is absolutely yes, because it's a continuous process. Especially if you know you've got your step, you're going to be raising, you know, 1, 2.5, 5 million, 10 million. You know you're going to keep going down that line. And then who you have your relationship with, what their bandwidth is, and will they support you all the way through? So, what are your thoughts on that?
Well,
just to close it on that.
Yeah, I mean, I would say once you've identified your investor and you have the makings of a relationship, find out who they've syndicated with, and what kinds of relationships do they have with these people. Find out where their syndicate partners are in their fundraising cycle. If one of their syndicate partners is, let's say, having a hard time raising fund number 3, and they might be going into this deal, they're obviously not going to be a prospect for you. So that's very, very important. It's also important to know where they are in their funding cycle. I had a guy a couple of years ago who had a SaaS company in New York, and he was called up to Boston to meet with a very prestigious fund. And they were in year 4 of their fund cycle, and they were starting to talk about a new fund, but this guy didn't know that, and he found out after the fact. And not only were they not able to write out the check, but the guy up there basically was leaving the fund. So he had to, if he was going to go back to that fund, had to sell it all over again to a different person. So I think that that's important.
Actually, I just had that happen in a situation on a deal where there was an interested fund, but the problem was they were out there raising on their second fund, and they were too distracted to actually pay attention to this company, and actually was in their sweet spot. So you do have to know that.
Well, yeah, I mean, what you just mentioned about the distraction thing happens on the entrepreneur side as well.
Right.
And that goes back to having the right team. If you have the right team, the business should still be running while you're doing your fundraising. And there was a company a few months back that I looked at, and the company had term sheets from 2 of our syndicate partners. They've been offered 2 term sheets, and we're still out there shopping the deal. And if you looked at their sales every single month, their sales were going in the wrong direction. And when you asked the CEO why, he said, oh, well, we're busy fundraising. And I'm saying you have two deals that were almost identical from 2 respected New York City angel funds, and you're out there fundraising while your sales are tanking. And needless to say, we didn't get involved with that company, and the other 2 groups didn't either. Everybody pulled back their deals once they saw that, but it was just stupid decision-making on the entrepreneur's part.
Was there a no-shop clause in it?
There was in one of them, and he was still shopping anyway.
That's great. So Dave, quick close. So.
Okay, so I'm not sure what the question was, Corey, but I'm just going to give you 1 minute here on what's the best thing for entrepreneurs to be doing. We're ADD investors. So entrepreneurs need to know how to do this 1 minute elevator pitch really, really well, because it turns out that almost all investors you meet and all the service providers that come to these kind of communities, they really want to help, but they don't want to get bogged down and they don't want to get overwhelmed. So if the entrepreneur could just approach them and say, look, this is where I am, this is what I'm going to do. Do you know somebody who can help me? Can you give me some direction? You flip the licapital.org website, but there's a lot of them, and there should be a lot of them. And I think entrepreneurs have to go to all those, let's call them haystacks, to find a needle that's in there, and go really well prepared. So be able to answer the questions on, because you're going to get guys like him who are going to be like, wow, I'm really following all your numbers, and I know what to, and he's, whoop, you're going to be ready for that. And that's why he's represented other investors. I'm representing my family, so I can't afford to make a mistake either, right? Thanksgiving dinner. And so the entrepreneur, most of the time I need to tell the entrepreneur to go to this place or that place, or I know a person who can help you much better than me, because again, I'm overwhelmed or I have ADD, I just can't help you. And entrepreneurs don't care. They're like, well, give me your money. And they're like, oh, come on. So he's disqualifying himself from getting the referral that he was just about to get. So entrepreneurs need to enjoy this, even though they're moving at the speed of sound. We're only moving like pedestrians,
So I'm going to give a very fast story. So this week, someone presented to me, did a presentation. We're at lunch for an hour. He spoke, and this company had raised $20 million. Ends up they really raised 40. He told me 20 when I got the deck. It was 40. But the point is, obviously they're doing something right. There's a family office that's heavily invested in them. But I sat there and listened to his story for an hour, and he was a very technical story about what they have, which is great. But he never spoke about the horse. So at the end, they asked for my feedback, and I said to the CEO, which I was, believe it or not, I was testing him. I said, "Who's going to run this?" And obviously he was taken back, and he got very defensive. And then he started flooding me with the horse and what it was and what it's about and why it's so great, because he spoke about his entire team. Now, to your point, if he had me locked up for an hour because I was sitting there eating, he would have lost anybody at this table because he never addressed it. The tidbit to that story is you gotta give the story about the horse first, and then go to the product and everything else, so that everybody
jockey
gets it.
first.
The
The
jockey
jockey
first,
first.
the jockey. You're right, right, all right?
Thank you for
Well,
passing the quiz.
thank you, everybody. Closing. By the way, I'm just gonna do the close, so thank you to all our presenters, thank you to our
Can I get a
panelists.
selfie with you before?
Oh, yeah, baby. And again, to our sponsors, thanking them. Our next entrepreneur education and mentoring series session, if anybody didn't know about this, we're doing mentoring and entrepreneurial sessions out here, is being held in collaboration with New York Institute of Technology on October 25th, and will cover attracting and retaining key employees, HR for startups and stock-based compensation. This is the second session in our program designed to teach entrepreneurs how to leverage their best practices to build a company from the ground up. Please refer to Leica's website at www.leicacapital.org, which will have the program. Join us at our next Healthcare Capital Forum, which will be on Friday, December 9th, for those of you that are into healthcare. So,
Corey, can I ask a question?
yeah.
On that compensation topic, I think entrepreneurs need to know that you know, as a CPA, how to compensate the boards of advisors and the boards of directors and those things, and entrepreneurs need to know that to attract people to them, so that's a very good reason to bother him.
Well, yeah, I wasn't going to say that to you before. I was thinking that, but I kept that to myself. But yeah, that's where there's a lot of failures from a tax, from a taxation, incentive, and retaining people, and the most efficient way to get the benefits. And there's a lot of other reasons, especially if you start doing commerce out there. You need a decent-sized firm that has to deal with your state and local tax issues. When you start doing commerce on the internet, there are a million traps. And I'm dealing with it right now in a couple of situations where they're getting in $27 million and it wasn't addressed. So that's enough, that's my pitch. All right, there is an event outside, lunch being held by Visionary, who's a connective organization. So if anybody's interested to stick around, that would be great. And again, thank you all for attending.